Hi Caroline, this is Trevor Angel, your tax preparer, just getting back to you about the questions you had on your tax return. The first question you had was how much money you owe, which is a great question. The amount that you owe is $84,716. So that is the amount that you owe after your credits and your refunds. So that's going to be the total amount that you owe come April 15th, 2016. So we do not want to get this tax return in the mail on April 15th. We want to have this tax return in the mail before April 15th because April 15th is when it is due. So that kind of covers your first couple of questions. So now we're going to hit the Schedule A, which you had a question about why the itemized deductions didn't add up to what you think they should. And that's a great question. Basically, the reason why they didn't add up exactly was because we had to put those deductions through an itemized deductions worksheet. And why we had to do that was because your income is significantly higher than the limit. So there's a certain limit to where if you're under that, then you can count the total amount of deductions. But if you're over the limit, then you have to start to phase those out, and the number's a little bit lower. So that's why it didn't add up completely. And if you'd like to talk about that more a little bit, we can set up a time in the future and discuss that. Your next question was about the Schedule C and why the income statement looked a little bit different than what you had initially set up for the Mystic Grill. And that's because of a few reasons. One being the charitable contributions were added back. And that's because the charitable contributions go on the Schedule A and not on the Schedule C. The Schedule C is for the income statement, and the Schedule A is for your deductions, and charitable contributions are counted as deductions. So we had to add those back, and then we had to add back 50% of meals and entertainment because you can only expense 50% of those for business purposes. And then finally, we had to increase the depreciation a little bit, which is great for you because the more depreciation expense you have, the better. That's the less amount you're going to have to owe. So for the depreciation expense, it's quite a bit higher than what you initially had because tax depreciation goes through a thing called a depreciation schedule, which has a little bit different rates than regular depreciation does. So we do a thing called a Section 179 deduction, and basically what the Section 179 deduction does is it takes the current year purchases of equipment, and if those purchases are under $500,000, then you can completely deduct the full purchase price of those equipment as long as they are not 39-year property. So we can talk more about that in the future, but basically what you had is you purchased 3 different 7-year properties, and then you purchased one 39-year property, and we were able to deduct the full purchase price of those 7-year properties, so which is great for you, and you should continue to do that in the future. But if you'd like to talk more about that in the future, we can definitely do that. Your next question was about what tax bracket you're in. And that tax bracket is the highest. It's 39.6%, and so you're probably going to have to, based on what you've told me, that your business is continuing to move forward and expand, you will probably stay in that tax bracket, most likely. So that goes into our next question: what will you owe in the future? Well, we can do something called estimated tax payments, which you had those on your current tax return, but we're going to do them differently. You did 20% of the income, basically your taxable income. You did 20% of your taxable income, and instead we're going to do 100 to 110% of this year's liability, estimating next year. So basically, with your estimated tax payments that you did on your current tax return, you highly underestimated it. So we're going to have to do a little bit better job of paying more taxes beforehand, so you don't have a big bulk tax payment towards the end, because you're having to pay a lot more than you should have in the end. So we're going to change that for next year. So looking forward to what you're going to have to pay, we can estimate that to about from using 100 to 110% of this year's liability and make estimated tax payments on that. And then what you'll have to sign the 1040 in order for us to get that sent off. You and Claus will have to sign that since it's married filing joint. So that covers all your questions. I would just suggest that we get together again at a future time in order to discuss Section 179 and depreciation a little bit more, and also to discuss itemized deductions. So thanks for your questions. I hope I answered them well, and we'll talk again soon.